I'm 680 News senior business editor Mike Eppel. It's already been a volatile week, and we're only 2 days into it on the financial markets. Monday, we saw a sell-off on Wall Street related to the Trump administration's crackdown on U.S. businesses, tech businesses specifically, doing business with Huawei and other big Chinese telecom companies. From a supply standpoint, they could be losing billions of dollars of business as the Trump administration has issued this moratorium on Huawei and its 5G technology coming into the United States. Now, today, they offered a temporary reprieve from all of this. And we saw tech stocks do a big-time turnaround. Shares of Intel and Qualcomm and Nvidia all sharply to the upside in the Tuesday trade. Even Apple, which was down over 3% Monday, bounced back in today's trading session. Which way next? No one knows. It has been certainly volatile, to say the least, over the past little while. Now, we also had a focus on U.S. retail spending and earnings today. Biggest home improvement retailer on the planet, Home Depot, issued the quarterly earnings for the first quarter. Numbers pretty good. $2.5 billion profit for the Atlanta-based company. Sales top $25 billion, and that was even despite bad weather for much of Canada and the U.S. in the first 3 months of the year. Their same-store sales growth also on the rise, and Home Depot's stock this year is up by about 10%. Now, having said that, we do have some big trouble for some traditional retail brands in the United States. Today, we saw shares of JCPenney tumble to almost penny stock status. The share price down at 1.10% as they issued quarterly earnings that fell short of expectations. Another name in the U.S., Kohl's, department store chain, seeing its share price down over 10%, also lowering its guidance for the year. And Dress Barn, this is a U.S.-only based women's clothing retailer, well, it's closing its doors. 650 retail locations set to close, not making any money, and this will raise the total of U.S. retail store closures this year already to more than 5,000. Which is more than all of 2018. And could Tesla tumble to $10 a share U.S.? That's the worst-case scenario in an analysis by an analyst at Morgan Stanley, worried about Tesla and its cash burn, and perhaps a slowing of sales in China related to U.S.-China trade issues, and a loss of momentum in sales of the new Model 3. Also distractions for CEO Elon Musk. Tesla today was at $200 per share U.S., and year-to-date it's down 37%. From the 680 newsroom, I'm Mike Eppel for City News.